Welcome to Talk Tickers. I am your host, and today we are bypassing the usual earnings calls and forward guidance to look at the machinery itself. We are going to stare directly into the abyss of the financial markets.
And not just look at it, but really try to understand what happens when the abyss stares back. It is great to be here.
Usually we are breaking down quarterly results for tech giants or analyzing Fed minutes. But to really understand how the modern market moves, you have to look at the moment it completely broke. We are doing a deep dive into the flash crash of May 6th, 2010.
This is one of those events that just divides market history. I mean, there is everything before May 6, 2010 and everything after.
Right.
If you were working in finance that day, you remember exactly where you were. You remember that feeling in the pit of your stomach.
I think for a lot of people, even those outside of finance, the headline was just impossible to ignore. We are talking about a day where the U.S. stock market lost nearly $1 trillion in market value.
$1 trillion. It's a number that's hard to even comprehend.
Poof, vaporized. And the craziest part, it happened in under 30 minutes.
And then, just as inexplicably to the people watching in real time, it gained most of it back almost immediately. It was a volatility event that just defied every rule of economics we thought we knew.
Right. I mean, usually when you see a crash of that magnitude, $1 trillion wiped out, there is a catalyst. A bank has failed.
A war has started.
A war has started. There is a tangible, fundamental reason for the panic. You can point to a headline and say, that is why.
Exactly. But on May 6, 2010, there was no Lehman Brothers moment. There were no tanks crossing a border. It was just a Tuesday afternoon that suddenly turned into a financial apocalypse.
The details, when you look back at them, are just absurd. I mean, they sound like errors in a spreadsheet. We had companies like Accenture, a massive global consulting firm, a blue chip company.
Solid as a rock, you would think.
Trading for a single penny, 1 cent.
Yeah, and on the flip side, you had Sotheby's, the auction house, trading at $100,000 a share. Briefly.
$100,000.
The pricing mechanism of the entire U.S. equity market just completely detached from reality.
So that's the mystery. It's the ultimate mystery. How does the most sophisticated financial market in the world just break? And having looked through the stack of reports, the regulatory findings, and the analysis on this, the answer seems to be this complex cocktail of algorithms, high-frequency trading, and, I love this part, a single guy in a bedroom in London.
It really is a story about market fragility and liquidity. We tend to think of liquidity, the ability to buy and sell easily, as a constant.
Like gravity?
Like gravity. Yeah, it's the perfect way to put it. We assume it will always be there. The flash crash showed us that liquidity is a ghost.
Yeah.
It can vanish in seconds if the microstructure of the market gets stressed in just the right way.
Okay, so let's unpack this. Let's get into it. We need to go back to that afternoon, May 6th, 2010. Set the scene for us. What was the vibe before the chaos really started?
Well, to understand the crash, you have to understand the mood. It wasn't a happy day to begin with. The market was already down about 4% by mid-afternoon.
And this was during the height of the European sovereign debt crisis, right? Greece
was the big worry, exactly. There were riots in Athens, buildings were burning, and there were these deep, deep concerns about the Eurozone fracturing. So traders were already on edge.
Right, so the background noise is already panic.
It is. The VIX, which measures volatility, what they call the fear index, was up over 22%. Investors were moving into safe assets like gold. It was a classic risk-off day.
Okay, so everyone is already nervous, tensions are high, but the market is functioning, it's down, but it's orderly.
It's orderly, correct, until 2:32 p.m. Eastern Time. That is when the tone shifts. But the real chaos, the part that made history, that starts at 2:42 p.m., the Dow Jones Industrial Average is down about 300 points.
Which is bad, but not catastrophic.
No, not at all. Not great, but normal for a bad news day. Then, in the blink of an eye, it accelerates.
And when we say accelerates, we mean free fall?
A vertical drop. Within minutes, the index plunges another 600 points. So now we are getting close to a 1,000-point loss on the day, which at that time was about 9% of the total market.
Wow. The visuals from this moment are legendary. You can find clips of the CNBC anchors, and they are literally stammering. They are looking at the screens, and they just cannot explain what they are seeing.
How could you?
They're seeing the Dow drop 200 points in the time it takes to finish a sentence.
And it wasn't just the anchors. I mean, think about the traders on the floor, the traders at their desks. They froze. You have to remember, human traders operate on logic.
Right, cause and effect.
Yes. If a stock drops 5%, you look for news. If it drops 30% in 10 seconds with no news, your brain rejects the data. You assume the feed is broken.
That's a key point. Many people thought the data was corrupt, that the numbers were just wrong.
But it wasn't. The trades were real. They were being printed.
Let's talk about those specific anomalies again, because they are just mind-boggling. Accenture, trading at a penny.
A penny. I mean, just imagine holding a stock worth roughly $40, and a second later, the market tells you it's worth 0 cents.
The system is telling you your $40 is now a penny.
And it wasn't just Accenture. Procter Gamble, one of the most stable, boring, reliable blue chip stocks in existence.
The company that makes toothpaste and diapers. It doesn't lose a third of its value in a coffee break.
You'd think not. It lost 37% of its value in minutes.
37%.
Exactly. And Apple, which even back then was a titan, saw a 60% price drop during this window. We saw over 20,000 trades, across 300 different securities executed at prices that were 60% away from their value just moments prior.
60%. It's like the entire concept of value just ceased to exist for a few minutes.
It did. The market's pricing function just broke.
And just as everyone is bracing for the end of the financial world as we know it, it stops.
It snaps back. By 3:08 p.m., so that's roughly 20 minutes after the absolute bottom, the market had recovered most of that $1 trillion loss.
It rebounded almost as violently as it crashed.
Almost, yeah. Which leaves everyone standing in the wreckage asking, what on earth just happened?
And that is the question that launched 1,000 investigations, right?
It is. Because this wasn't a crash in the economic sense. It wasn't a revaluation of assets because the economy tanked overnight. It was a microstructure failure. The plumbing of the market broke.
The plumbing. Okay, let's get into that plumbing. Because the official investigation pointed to a specific catalyst, the first domino. And it leads us to a mutual fund complex called Waddell and Reed.
That's right. In the middle of this tense afternoon at 2:32 p.m., Waddell and Reed decided to execute a massive sell order. They wanted to hedge their equity positions, so they went into the futures market.
And not just any futures market.
No, the big one. Specifically the E-mini S&P 500 futures.
For those listening who don't trade futures, the E-mini is basically the heavy hitter of the market, right? It's where the big money sets the tone.
It is the primary instrument for price discovery in the U.S. markets. It's extremely liquid, extremely active. If the E-mini moves, the S&P 500 moves. There's no escaping it.
So Waddell and Reed comes in with this sell order. How big are we talking?
They initiated a sell order for 75,000 contracts.
Put a dollar figure on that for us.
At the time, approximately $4.1 billion.
Okay, so $4.1 billion. That's a lot of money. But in the grand scheme of the U.S. markets, which trade trillions a day, is it really enough to crash the whole system?
It shouldn't be. And that's the absolute key. It's not just what they sold, it's how they sold it.
This is where the algorithm comes in.
This is where the algorithm comes in.
Yeah.
Generally, if you are a fundamental trader and you want to dump $4 billion of futures, you do it carefully. You're quiet.
You want to slip out the back door without anyone noticing.
Precisely. You don't want to spook the market.
Yeah.
You might use a human trader to work the order or an algorithm that is sensitive to price.
Okay, a smart algorithm.
Right. But Waddell and Reed used an automated execution algorithm that had a very specific and, as it turns out, very dumb parameter. It was programmed to target trading volume. Specifically, it wanted to be 9% of the trading volume of the previous minute.
Okay, walk me through why that is a problem. On the surface, targeting a percentage of volume sounds responsible, like you're trying to blend in.
In theory, yes. It sounds like you're trying not to be the whole market. But here's the fatal flaw. The algorithm didn't care about price. It didn't care about time. It only cared about that volume metric.
Yeah, it had no breaks.
No breaks at all. So let's play this out. The algorithm starts selling its contracts. That action of selling adds volume to the market.
Right. More trades are happening.
So the algorithm looks at the data from the last minute and says, oh, look, volume is up. That means the market is more active and can absorb more. So I can sell even more contracts to maintain my 9% ratio.
Oh, no. So it sells more.
Which creates more volume.
Which tells the algorithm to sell even more.
You've got it. It created a self-reinforcing feedback loop. It chased its own tail all the way into the ground. It was programmed to see high volume as a green light without understanding that it was the one causing the high volume.
It's like a car that speeds up the more it spins its own wheels. A snowball rolling down a hill getting bigger and faster.
That's a great analogy. And to give you a comparison, Waddell and Reed had executed a trade of this size previously It took them over 5 hours to carefully unload it.
5 hours? That sounds more reasonable.
Right. On May 6, 2010, this aggressive algorithm tried to push the whole thing through in 20 minutes.
20 minutes. So they are dumping $4.1 billion into a market that is already nervous, and they are doing it with an algorithm that is essentially hitting the gas pedal the faster the car goes.
Precisely. And this is happening during a time when, as we said, the market was fragile, liquidity was already thinning out. By 2:30 p.m., the buy-side liquidity in the E-mini, the number of standing buy orders, had already fallen by about 55% from the morning level.
So the cushion was already half gone?
The cushion was gone. And then this massive sledgehammer of a trade came down on it.
But the Waddell and Reed trade is just the match that lit the fuse. The explosion itself came from the accelerants, and that brings us to the high-frequency traders, the HFTs.
This is where it gets really interesting and a bit technical. HFTs are firms that use powerful computers and algorithms to trade in milliseconds or microseconds. They aren't investing in companies in the traditional sense.
Right, they're not poring over balance sheets.
No, they are scalping tiny profits on minute price movements. They're exploiting tiny, fleeting arbitrage opportunities.
And they are also the market makers, right? They are the ones who are supposed to provide the liquidity. They stand there ready to buy when you want to sell and sell when you want to buy.
They act as market makers, yes. They stand ready to buy and sell. But, and this is but unlike the old human specialists on the NYSE floor who had a duty to maintain a fair and orderly market, HFTs have no such obligation. If things get hairy, they can just turn off.
They can just leave.
They can just leave. Their only obligation is to their own profit and loss.
So the massive Waddell and Reed sell order hits the market. Who is on the other side? Who is buying it?
Initially, the HFTs. Their algorithms see the sell order coming in and they buy the contracts. It's what they do.
Okay, so far so good. They're providing liquidity.
For a microsecond, yes. But HFTs hate holding risk. Their entire business model is based on ending the day flat owning nothing. They don't want to own $4 billion of the S&P 500. They just want to buy it at $100 and sell it at $100.01 a millisecond later.
Ah, so this is the hot potato effect I've read about.
That is the perfect term for it. They bought the contracts from the Waddell algorithm, but they immediately realized the price was falling rapidly. So they instantly tried to sell those same contracts to get out of the position and reduce their risk.
And who did they sell to?
Well, that's the problem. The fundamental buyers, the pension funds, the mutual funds, the real long-term investors, were on the sidelines or just moving too slow. They operate on a human timescale. So the HFTs ended up selling too.
Other HFTs.
Other HFTs, yes. You have this swarm of algorithms passing these toxic contracts back and forth to each other at lightning speed.
And every single time they pass the potato, the price ticks down.
Down and down and down. Let me give you some numbers on this. Between 2.45.13 and 2.45.27, that is just 14 seconds.
14 seconds.
HFTs traded over 27,000 contracts. That is huge volume. It accounted for 49% of the total volume in that window.
49%. That sounds like a lot of liquidity.
It's fake liquidity. It's phantom liquidity. That's the illusion. They traded 27,000 contracts. But, and this is the kicker, they only bought a net of 200 additional contracts.
So they weren't actually absorbing the sell pressure.
Not at all. They were just churning the same contracts back and forth, creating this massive volume data that looked like a healthy, active market, but no one was actually taking on the risk. It was a mirage.
So the algorithm from Waddell and Reed sees this massive volume spike caused by the HFTs playing hot potato, and its programming says, great, huge volume, the market is deep, I can sell even more.
Exactly. The HFTs effectively tricked the Waddell algo into dumping even faster and harder. And there's another slightly more sinister concept here called immediacy absorption.
What's that?
HFTs are smart. Their algorithms are designed to predict price direction. When they saw the price plummeting, they didn't just step aside, they got aggressive. They started actively removing liquidity.
What do you mean by that?
They sold into the drop to clear out their own inventory. They would see the few remaining buy orders on the books, and their algorithms would race to hit those bids to sell to them before anyone else could. They were effectively eating up the last of the available buy orders that were there.
So they were demanding liquidity exactly when the market desperately needed them to provide it.
You've got it. It's like they were drinking the water when the house was on fire.
Wow.
And the data backs this up. Data shows that HFTs and the official market makers actually accounted for a smaller percentage of volume on the day of the crash compared to prior days, which indicates they either pulled back their capital or just got run over by the sell-off.
So we have a sloppy, aggressive sell order. We have HFTs playing hot potato and making it worse. But there's another character in this story, the one that makes it feel like fiction, the Hound of Hounslow.
Navinder Singh Sarao. This is the part of the story that just feels like a movie script. You have these billion-dollar banks, high-speed fiber optic cables running under the Atlantic, massive server farms in New Jersey. And then you have Navinder sitting in his parents' house in a suburb of London, trading on a retail internet connection.
And he wasn't just a small fish. From what I understand, he was a whale.
He was a massive whale. He was a futures trader who had developed his own custom software. And his strategy was something called spoofing.
Okay, break down spoofing for us. How does it work?
Spoofing is the act of placing a large order, in his case, usually a sell order, with absolutely no intention of ever executing it. You place a massive wall of sell orders just above the current market price.
Why? What does that do?
It's designed to trick the other robots. The HFT algorithms see this massive sell wall appear on the order book, and they're programming things, oh wow, there is huge selling pressure coming, supply is high, the price is going to drop.
So the HFTs start selling to get ahead of the drop that they think is coming.
They front-run the pressure that Sarao created.
That's right.
Which, of course, drives the price down for real.
And then what does Sarao do?
He then cancels his massive sell order milliseconds before it can be executed.
Yeah.
And he buys the E-minis at the new lower price he just artificially created.
So he scares the market down, buys the dip that he caused, cancels the scare tactics, and then profits when the price rebounds.
That's precisely. It's market manipulation 101, but it's being done at algorithmic speed. He weaponized the HFT's own speed against them.
And on May 6, 2010, the day of the crash, he was doing this.
He was incredibly active. The reports show he entered over 85 large spoof orders that day.
85?
At certain points during the day, his fake orders represented 20% of the entire visible sell side of the E-mini S&P 500 market.
Wait. 20%? One guy in a bedroom.
One guy in a bedroom.
That is terrifying. That one person could represent a fifth of the visible market pressure of the S&P 500.
It shows you just how thin the market actually was that day, how fragile it was. Now, it is important to note, and regulators were clear on this, Sarao didn't cause the crash by himself.
Right. He wasn't the first domino.
He wasn't. But he tipped a fragile system. He was a huge contributing factor. His orders modified the behavior of other HFT algorithms, which exacerbated the liquidity crisis at the worst possible moment. He was pouring gasoline on the fire.
And what happened to him?
He was eventually arrested in 2015, pleaded guilty to wire fraud and market manipulation. But in a twist, he was sentenced to home confinement. Basically, time served, because the prosecutors themselves admitted he was just a trigger, not the sole cause of the crash.
It is just so ironic that a single guy in a bedroom outsmarted or at least manipulated the most sophisticated banking algorithms on Wall Street.
It really is. It shows you the vulnerabilities in the system.
Okay, so we have the trigger, which was the Waddell and Reed algorithm. We have the accelerants, the HFTs, and we have the manipulator, Sarao. Now let's look at the mechanics of how this spread, because it started in the futures market, but it absolutely destroyed individual stocks like Accenture and P&G. How does that contagion happen so fast?
The answer is arbitrage. In modern finance, everything is connected. The E-mini futures are designed to track the S&P 500 index. The SPY ETF is also designed to track the S&P 500 index. And the individual stocks, Apple, Procter Gamble, Exxon, are the components that make up the S&P 500. Theoretically, they should all move in perfect lockstep.
And there are algorithms designed specifically to enforce that lockstep.
Billions of dollars of them. So if the futures contract suddenly tanks, the arbitrage bots instantly say, hey, the futures are cheap relative to the stocks are expensive. So what do?
They sell the stocks and buy the futures to close that price gap.
Exactly. The arbitrage bots act as the transmission lines for the panic. When the E-minis tanked, arbitrageurs sold the SPY ETF. And they sold the underlying stocks to keep all the prices aligned. The fire jumped from the futures market to the stock market in microseconds.
And this is where the liquidity evaporation in the stock market gets real.
This is where it gets terrifying. As the prices of individual stocks were in free fall, the market makers, the firms who are legally required to post buy and sell quotes, they effectively stepped out of the way.
But they have to post something, right? They can't just show a blank screen.
They have to post something. So what did their automated systems do? To comply with the exchange rules that require them to post a two-sided market, a bid and an ask, their automated systems posted what are called stub quotes.
Stub quotes.
They are the placeholder bids at ridiculous prices, like 1 penny, or on the high side, $100,000.
Assuming no one in their right mind would ever be crazy enough to actually sell their stock for a penny.
Right. It was just a placeholder to meet the rule, assuming no rational market order would ever hit a bid that low. But on May 6th, there was no rationality. Because all the reasonable buy orders had been exhausted by the wave of selling, the incoming market sell orders cascaded down the order book until they hit.
The penny bids.
The penny bids. And that is how a company like Accenture, a multi-billion-dollar global consultancy, traded at $0 or 1 cent. A real trade executed at a penny.
That is just incredible. And on top of that, you also had some firms just hitting the pause button themselves?
Yes, you had what were called data integrity pauses. Some firms, their own internal risk management systems, paused their trading not because of panic, but because their systems flagged the incoming market data as corrupt.
The price moves were so extreme, their own computers thought the data feed had to be broken.
Exactly. So they shut down to protect themselves from trading on bad data. But the effect was they further withdrew liquidity from the market at the exact moment it was needed most.
It's a perfect storm, one failure cascading into the next. So how did it stop? What pulled the market back from the brink?
It was a 5-second pause.
5 seconds. You're telling me this whole trillion-dollar catastrophe was halted by a 5-second timeout.
That's exactly what I'm telling you. At 2:45.28 p.m., the Chicago Mercantile Exchange's stop logic functionality was triggered in the E-mini futures market.
Stop logic functionality sounds like a circuit breaker.
It was a very primitive, very fast one. Essentially, if the market moves too far too fast, it just halts everything. And in this case, the halt was for exactly 5 seconds.
Just a quick timeout.
A tiny timeout. But you have to remember, in the world of high-frequency trading, 5 seconds is an eternity. It is millions of milliseconds.
A lifetime.
It's a lifetime. That tiny pause did 2 crucial things. 1, it allowed the algorithms to reset and clear their queues. 2, and maybe more importantly, it gave human traders a moment to breathe and assess the situation.
It allowed logic to catch up to the speed of the machines.
Yes. A human trader could look at their screen and say, hey, Procter Gamble at a 37% discount. That's a steal. That makes no sense. The fundamental value buyers had a chance to step in.
And the buying came back in.
Buying came back. When trading resumed after that 5-second pause, prices stabilized almost immediately and began their rapid rebound. By 3:00 p.m., most securities had returned to prices that reflected their fundamental values.
The terrifying realization in all of this is that a 5-second pause in one futures market likely saved the global economy from a much longer-term, much more damaging catastrophe.
It absolutely did.
Yeah.
If that pause hadn't happened, we don't know where the bottom would have been.
So naturally, after an event like this, the regulators had to step in. They couldn't just let this happen again. What changed?
A lot changed, and pretty quickly. First, the most obvious one, the stub quote ban. Regulators flat out banned the practice of placing those placeholder bids at a penny or at $100,000.
Makes sense.
Quotes now have to be within a reasonable percentage of the current market price.
Okay, what else?
Then they introduced single stock circuit breakers, which are officially known as the limit up, limit down plan, or LULD.
So individual stocks got their own timeouts.
Exactly. The new rules prevent trades from occurring outside of specified price bands. So, for example, a stock can't trade more than 5% or 10% away from its average price over the preceding 5 minutes. If a stock tries to move outside that band,
Pause is triggered.
a 5-minute trading pause is triggered for that specific stock. It gives everyone a chance to cool down and reevaluate.
So no more Accenture 2 penny situations.
That's the goal. They also revised the big market-wide circuit breakers. They changed the benchmark for the Dow to the broader S&P 500, and they set clear thresholds for halting the entire market at 7%, 13%, and 20% declines.
And they had to go after the spoofers, like Sarao.
Yes. The Dodd-Frank Act, which was passed in 2010, partly in response to the financial crisis, formally defined spoofing as an illegal form of market manipulation, giving prosecutors a much clearer tool to go after it.
And what about the data? I remember it took them months to piece together what actually happened.
That was a huge problem. So they mandated the creation of the Consolidated Audit Trail, or CAT. It's a massive centralized database designed to track every single order, modification, cancellation, and trade across the entire U.S. market.
So they can reconstruct an event like the flash crash in hours or days, not months.
That's the idea. And one final important rule, the naked access ban.
What's that?
Before the crash, some broker-dealers were allowing HFT firms to connect their trading systems directly to the exchange's matching engine, bypassing the broker's own risk management controls.
That sounds incredibly dangerous.
It was, so they banned it. Now all orders, even from the fastest HFTs, have to pass through a broker's pre-trade risk checks.
So we have more rules, better breaks, and better monitoring systems. The multi-trillion-dollar question is, are we actually safer now, or have the risks just shifted and evolved?
That is the big question, isn't it? We fought the last war, we solved the 2010 problem, but now we have a new elephant in the room. Artificial intelligence.
Before we get into that, how did 2010 compare to, say, the 1987 Black Monday crash?
That's a good comparison. In 1987, the S&P 500 actually underperformed the broader market by about 7%, which was strange. In 2010, the S&P 500 also underperformed, but the gap was much smaller, less than 1%. It tells us that beta stock sensitivity to the overall market remains the best predictor of which stocks get hit hardest in a crash. High beta stocks fall further.
Okay, so some things stay the same, but AI introduces a completely new kind of risk.
It introduces several. The first is what some people call algorithmic herding, or monocultures. Think about it. If all the major investment firms are using similar AI models trained on similar data sets,
they're all going to come to the same conclusion at the same time.
At the exact same microsecond, they will all decide to sell at once. It's a herd mentality, but at the speed of light.
And you get feedback loops.
Vicious feedback loops. AI models reacting to their own output or the output of other AIs, creating these self-reinforcing cycles of volatility that can be far faster and more violent than what we saw in 2010.
And a huge part of this problem is that these models are black boxes, right?
That's probably the scariest part. Even the engineers who build them often cannot explain why a deep learning model made a specific trading decision. There's an issue of explainability. So if an AI-driven flash crash happens, we might not even know what caused it.
And they can be attacked.
Yes, adversarial vulnerabilities. The potential for bad actors to poison the data that these AIs are trained on, to intentionally trigger selling cascades at a time of their choosing.
And we have these massive points of centralization now, like BlackRock's Aladdin platform.
Right. Aladdin is the risk management platform that oversees over $21 trillion in assets.
21 trillion.
The nightmare scenario that keeps regulators up at night is, what happens if a system that large hallucinates a risk that doesn't actually exist? What if it misinterprets some data and triggers a massive coordinated sell-off across all the assets it manages?
A crash that happens in nanoseconds, not minutes. Too fast for any human or any circuit breaker to even react to.
It's exactly. The 2010 flash crash was a critical warning. It was a warning about the incredible speed of failure in automated, interconnected systems. And our systems are only getting faster and more interconnected.
It's a very sobering thought. So to recap our deep dive today, the flash crash wasn't caused by one single thing. It was a perfect storm.
It was. A large sloppy trade from Waddell and Reed combined with the aggressive risk-shedding behavior of HFTs playing hot potato.
And topped off with the illegal manipulation from a single trader, Navinder Sarao, who exploited the system's weaknesses.
And fundamentally, it revealed that market liquidity is an illusion. It's a promise that can be broken, and it can vanish in seconds.
Which leaves us with the final question. As we move from milliseconds to nanoseconds, and as human oversight continues to decrease, the question remains, are we safer now with all these new circuit breakers, or are we just building a system that's waiting for a crash too fast for any breaker to catch?
The provocative thought to leave you with is this. Do you trust the black box with your retirement?
That is something for everyone to think about. Thanks for listening to Talk Tickers. We will catch you on the next deep dive.